In this tutorial, I'll be going through with your Zendesk stock. Just type it in Google, press enter, and I can see the full name Zendesk Inc. and it's Zen is the symbol, and it's 76.34 US dollars for one stock right now. It's a billion size firm, it's a big size firm, and it doesn't have any it's not giving any dividend. So I just want to point out companies that are paying dividend, that means they're financially very strong because they have extra money after paying their cost, liability, creditors. They still have extra money. That extra money, if you're paying the shareholder as dividend, so it means they're financially very, very strong. Even if the dividend yield is less than 1%, less than 0.5%, that is the strength of the firm because that's extra money. But a firm that is not paying any dividend, it could be they're not financially strong, or it could be they are financially strong, but they choose to reinvest in their own firm to further expand instead of paying to shareholders. So there could be many reasons. It's up to you to find out what are the reasons behind this company not paying dividend, which is very important to know. And I can see from Wikipedia when was this founded. This is the box here, and you can see that it was founded in launched in 2007, I think, 12 years ago. And I'll just copy this exactly from Google, right? And I want to know what the employees have to think about this form, which is very important for me to know as well, who work there. So I'll check out in Indeed, which is I'll check out in Glassdoor first. Actually, it's 472 reviews. It's 4.3 star. Please read through the reviews yourself. Check out the jobs listed, the salaries they're paying, interview questions, the benefits they're giving, and the photos of the firm. And now let me check in Indeed as well. So I can see we have 28 reviews. It's 4.4 star. Read through the reviews yourself, check out the questions and everything. Now I want to go to just your patents and see if this firm has any patents. So I'll just paste exactly from Google, click enter, and please concentrate on applicant or assignee because these are people who have full rights of the patents. And I can see in 2011, 2015 they have patent, 2012. Please look for recent patents because that means they're still innovating, which is important. So go through the list yourself. It's a big list, I guess, and the more the patents a firm has, the more stronger it is in the market, and it's difficult to beat that firm. So bear that in mind. And let's go to Yahoo Finance, and please look at the key executives and their salaries, which is important for us to know. And I'll just paste this exactly here, and Zen is the symbol. And I'll just click profile, and you can see the sector here, the industry, and the employees. And I can see 5 key executives, all of their salaries are shown. That's brilliant because we can see all the salaries, so it builds transparency and it builds trust with this firm, which is brilliant. And now let's lastly go to macro trend and compare some ratios. Click price ratio, price book ratio, and type in the symbol or the name. And if the price book ratio is less than 1, that means stock is undervalued, it's cheap, it's sale. If it's more than 1, that means stock is expensive. The higher the number goes, the more expensive it gets. Let's have a look. Okay, I can see right now. I can see that it's 19.79, which means if somebody buys a stock in August 2019, they'll be paying 19 times more money. It's 19 times more expensive, which is very expensive. In June 2019, it's 23 times more expensive. Somebody who bought that time, they paid $89 to buy something that was only $3.8 worth. So they paid 23 times more money. Right now, it's 19.7 times more money. And I can see that in 2015 September it was 5.9 times more expensive. So people paid $19 to buy something that was $3 worth. So that's something to consider. Let's go to other ratios. I want to see current ratio. I'm looking for, if current ratio is less than 1, that means stock is risky because liabilities are more than assets. If current ratio is 1.5 or more than that, that means stock is safe. It has a good margin of safety. Please look for 1.5 or more than that. Right now, I can see that it's less than 1. That means if you see vertically up, liabilities are more than assets. It's a risky stock. Let's look at the previous trend. It is more than 1.5. That means stock is safe. Let's look previously and let's look at the trend. So for once, it has been less than a little bit less than 1.5, but I just want to see the consistency. That's very important for me. And then it's less than for once 1.3. So I can see that from 2012 consistently, since we have the data up till 2019 March, it's always been a safe stock. It's always been a 1.5 or more than that, except once or twice. So that's fine. But recently, just now, it is less. It's less than 1. So liabilities are more than assets. So recently, it's a risky stock. Let's go to debt equity ratio. This ratio will tell me if the company is mainly operating on debt or equity. I'm looking for 0.5 or less than that for it to be safe. Let's have a look. So I can see that it's less than 0.5, so it's a safe stock right now. As of June 2019, it's safe stock. Let's look previously. So in March 2019, it's a risky stock because, you know, if you see vertically up, the debt is more than equity, which means companies mainly operating on debt instead of equity. So it's a risky stock. Let's look at the back, and it is a risky stock. So as far as we have information, I can see that since 2012 up till 2014 March, it's a risky stock because I can see minus equity and debt is positive and equity is minus. So it's a risky stock. So it's mainly operating on debt, exclusively operating on debt. But then since 2014 June, it's a safe stock because it's less than 0.5. That's brilliant. Up till I would say up till 2015 March, for a short period of time, it's a safe stock. And then from 2018 March, okay, it became a risky stock because debt is a lot more than equity. And since then, up till 2019 March, it's very dangerous. It's very risky. It's mainly operating on debt. I would say, but just recently it's less. So it's fluctuating. There's no consistency, I would say. So right now it's a safe stock, but I don't know about. We have data until until June. June 2019, but we don't have data of August right now. So I don't know what's the situation. Maybe it's the debt is more than equity or equity is more than debt. I don't know. So it's fluctuating. There's no consistency, I guess. So it's up to you to decide. Let's go to return on equity. I'm looking for 8% or more than that for it to be brilliant. Let's have a look. Sometimes this website will take time to load, but don't worry because it has a lot of data. But this will make your life quite easy, so be patient with it, please. I can see that right now it's a minus return on equity. So since 2013 and consistently up to now, it's a minus return. So it's not a return I'm looking for.